now. Today's webinar is part of the KoSI webinar series, the Competence Center for Social Innovation, which is co-financed by the European Union. And we have had a few webinars so far. Today is the last one, actually. So welcome to this. I will jump right into kind of like the agenda of what we have planned for today. And that is essentially the following. First, I'll give you a little bit of an overview of FASE, that's where I work, the Financing Agency for Social Entrepreneurship, and the KoSI webinar series. And then we will speak a little bit about distinct characteristics of financing for social enterprises and impact startups. How does it differ from, let's say, typical startup financing, for example? And then we will dive deeper into what financing options are actually available for social enterprises and impact startups. And then us at FASE, coming from the side of like impact investing, I will dive a little bit deeper into the role of impact investors and how they differ also from each other. So we have quite a bit of content here. A little bit of housekeeping also before we start. You realize that you had to click a kind of like accepting that this video button, accepting that this video will be recorded, that this webinar will be recorded. We will put all these webinars, so far we have put them online at the website that you can see on this slide. And we will also plan to put this webinar online afterwards. So if you have any friends who, for example, couldn't come and join today, you can also rewatch it online afterwards. So essentially, the webinar series, what have we talked about so far in the past sessions? Essentially 5 different topics that we've covered. One was that of impact investing. Another one was with regard to measuring and managing social impact. We had another one on investment readiness for social enterprises and one on scaling impact and system change. All of those 4 webinars you can watch on the website, on the KoSI website. And today the focus on financing options for impact startups. Now that almost everyone is has joined so far, a quick introduction about myself. My name is Christoph. I'm a transaction manager at FASE. FASE is the Financing Agency for Social Entrepreneurship. We're based out of Munich, Germany. I myself am based in Berlin, though. And we have so far worked for the past almost 10 years on building bridges between essentially social enterprises and impact investors. So we typically support social enterprises in raising funding, mainly from impact investors. I will share a little bit later on still a few words on FASE, but let me maybe dive right into the content for today. And I want to start by giving kind of a little bit of an overview of the social entrepreneurship and why social entrepreneurship effectively also differs from, let's say, the startup scene, where it's maybe not a focus on social and environmental topics. So typically what we see is that as social entrepreneurs, it's kind of between the business world and the social world, right? So you can be a social entrepreneur either for profit, you can also be a social entrepreneur non-profit. And essentially it's about kind of using the entrepreneurial mindset and creativity, risk-taking, all this entrepreneurial spirit to essentially work on topics that overcome social problems. And similar for impact startups, when we not only look at social, but for example, also environmental causes at a whole. So essentially, with this definition come also different challenges that differ in particular when it comes to raising funding or finding financing options for social enterprises and impact startups. Now, what we typically see, and this from us coming, working mainly with impact investors, is that when we look at investment, which is typically something that a lot of social enterprises or impact startups would want to raise, the majority of investors wait kind of we call it at the end of the pipeline, which means essentially that about 85% of impact investors globally do expect a financial return that is at or close to market level. What does market level mean? Essentially comparable to any other company out there. And that does pose certain challenges, in particular for social enterprises that might not fulfill these kind of like requirements of having, for example, a market rate financial return. That essentially, what that means is that, especially for early stage social enterprises, it's very difficult to find like appropriate financing mechanisms, because it's kind of like in the between the for-profit sector, the non-profit sector. Sometimes it's like a hybrid form. So if you, let's say you have like a very typical for-profit company, maybe you can achieve some sort of like market rate returns, and maybe there is an exit expectation that this company can be sold, for example. But that will not be the case for a non-profit, and also that will most likely not be the case for kind of like a hybrid mechanism where you have like for-profit and a non-profit entity, for example. So that does lead to certain challenges, and part of today's webinar will be to kind of like see how can actually social enterprises be financed, what kind of like mechanisms and opportunities are out there. And then also later on dive deeper, in particular the funding part from impact investors that can be one part of financing social enterprises and impact startups. Just as a kind of like housekeeping on that regard as well, I do have a chat here that I will try to manage in parallel while I'm speaking. So if there's any questions, anything that you don't understand, or things that you would like me to go a little bit into deeper, feel free to just type your question in the chat, and I'd be happy to take it up either directly during the webinar or later when we have kind of like a Q&A session at the end of today's webinar. I mentioned already a little bit about FASE, which is where I work. So I'm essentially a transaction manager at FASE. So I work with social enterprises and impact startups in raising investment from impact investors. And FASE essentially is this bridge builder between those two worlds. So on the one hand, we support social entrepreneurs in further defining and developing their business models, and then also work with them in building a storyline that is attractive for investors based on obviously the principles, the foundation of what that company has, what that social enterprise has. And then we have a network of about 1,500 impact investors all across Europe that can reach out very targeted based on the needs of the social enterprise, depending on how much money they need, what ticket sizes, for example, they are looking for, and in particular also what return expectations are relevant. And what we do see obviously is that in particular social enterprises that have like a very clear social focus cannot have the same kind of like financial returns, such as, for example, let's say a climate tech startup where there's, for example, much more money in the market and much different exit opportunities out there. But anyway, if I don't want to go into too much detail about like what FASE does, if you have any questions on that, feel free to send me an email. My contact details I'll be sharing at the end of today's webinar as well. So if that's something that is interesting for you, feel free to let me know. Now, I will share a slide that might seem a lot of content on one slide. So don't bear with me, and let's dissect this slide all together. Essentially, there are a lot of different financing options for social enterprises, and I will go through them one by one, and then we'll do like a deep dive into certain aspects of that later on. So essentially, it all starts with a financing form. You can differentiate between two types of financing, essentially, or financing forms. One would be that of internal financing, and the other one would be that of external financing. So internal financing is everything that you create, like the funding mechanisms that are from within your company, essentially. It means essentially the revenue that you create through different means. And then you have external financing, and external financing can have various forms as well that can range from grants to investment to credits and loans and the like. So essentially, first important differentiation here, as a financing option for social enterprise, you have either internal financing or external financing. Now, what does that mean in terms of the financing source? In terms of the financing source, it means, now if we stay on the internal part first, you either have the option as a social enterprise typically that your revenue, for example, or like, the service that you sell is paid for by the public sector. That means by, for example, government entities that, for example, use your social enterprise essentially as a possibility to finance a certain, social cause, and therefore essentially you will be paid by the public sector. The alternative to, for example, being paid by the public sector would be that you are paid for by either the target group or the beneficiaries. So that can mean, for example, let's say if you work, let's say in elderly care, for example. If you work in elderly care, there's typically a possibility that, for example, a health insurance would, pay for your service. So that would be, for example, the target group, that would be the, health insurers. It could also be that, for example, the elderly or like, family, that are related to the elderly pay for that particular service themselves. So that would be, for example, one aspect. On the other side, however, for the public sector, it could also be, for example, let's say if you work in elderly care, that it is a part of a government program that finances, for example, certain like elderly care homes or the like, and therefore, for example, the public sector, the government entities essentially would be the ones that pay for the service or the product that you deliver. And essentially, if we go back to the slide, it means essentially the income stream, or kind of like in that regard, on the internal finance side, the income stream would be what I just described for the public sector, essentially, service remuneration, for example, or subsidies that could be paid by the public sector. When it comes to the target group or the beneficiaries, it could be, for example, revenue, it could be sponsoring, it could be membership fees, depending on the type of business model that you essentially have, right? Now, so main point here, important to kind of like understand. So there is obviously a possibility, and that should, in our opinion, always be kind of like the first way to look for the way to have some sort of like internal financing source, financing form, and that can be then either the public sector or it can be, for example, a target group that essentially pay for your service. Now, why is it important also that you have some sort of like internal financing? Is when it comes in particular also to like getting investors on board, because investors in that regard differ from like donors or philanthropists, that they would like to see their money back, right? And if you cannot, have some sort of like internal revenue, you cannot pay the investors back, right? So it's like closely linked, this part of like the internal financing with that of the external financing when it comes to raising investment. Now, what I want to do now is like look at the other side, kind of like now we had a look at the internal financing part. Let's look at the external financing part. Essentially, when we look at external financing, it essentially means that any financing that comes, the way the word describes it already, from external financing sources. And there essentially are three main kind of like categories, so three main groups that we can look at. And it depends a little bit on whether you are a non-profit or whether you are also a for-profit entity. And there will be different opportunities there, which I will share in more detail later on. But so if we look at like the external financing, the first part, or like the first financing source, could again be, for example, public sector or also foundations. And that typically then would be some sorts of like grants or donations. So for example, like when we look at the foundation side, very often foundations give like, specific grants that, have a, certain, that are supposed to like, deliver a certain outcome or like output from your company. And therefore, like they are typically very often not like money that you can use freely, but they are very targeted to, for a certain project or the like, even though obviously also free available grants are available, but they're not, in our understanding, not that often. And there's an interesting part also, like when it comes to like public sector, that there's quite a lot of different grant programs as well. And there it differs again, whether you are kind of like a for-profit or a non-profit entity. Like what we do see in Berlin, for example, is that there's more and more that funding programs that were typically geared towards non-impact enterprises are more and more also opened to impact enterprises and social enterprises, and even new programs are being launched to give grants specifically for social enterprises and impact startups. In Berlin, there's, for example, a new one which is called Pro NTI, which is like a program for like non-technical innovation, which is specifically geared to, in particular, social enterprises. And that can be a very good means of funding, in particular for early stage social enterprises and impact startups, to, for example, bring the company to like, you know, a first proof of concept, to first revenues, and kind of like more stability as a social enterprise. So that is one aspect that external financing can be. Another one, and that is something that we typically see also mostly for nonprofits, that would be those of donations in general from philanthropists, for example. That can be smaller donations, obviously, you know, like the 100 euros, the 50 euros, the 20 euros here and there from private individuals, but also larger donations. Now, if you look at, you know, for example, it could be foundations that give donations, but it could also be, you know, just individuals that, you know, want to give out, for example, larger sums of money as a donation. And then we have like the last part of external financing, which essentially is that of investors, in particular impact investors. And there's different financing instruments, which I will go a bit deeper later on in the presentation as well. And investors, and that's, I think, one of the important aspects here as well. In order to be able to raise investment from impact investors, it needs to have the combination of either an internal financing source and then an external financing source, because investors typically would want to see that the money can be paid back somehow. And for that, you need to have also revenues that are to be created. Now, what that means essentially is that if you are, for example, a nonprofit and you don't really create you know, profits in your company, and those profits can be used to pay back investors, that makes it difficult to attract funding from impact investors. So you might have to rely more on donations or on grants from like the public sector or foundations, for example. But yeah, so that being said, what I now want to do is I want to dive a little bit deeper into the aspect of external financing, and in particular of investors, because that is typically one question that we get asked a lot, and that we see is, you know, important to understand also from the nonprofit, but also from the for-profit side, because very often we do get asked the question, like, we do want to have like investment, but what do we need to do to get it actually? And how do investors even think about giving out investment? And there are different types of investors that require different answers, essentially. And I want to touch a little bit more onto that topic. So essentially, still, before we dive very deep into that topic, it depends really a lot on your business model, right? So if you are a nonprofit, you would rather look at non-repayable capital. What I mentioned earlier, that would be like grants and sponsoring, for example, or donations. And that essentially would mean you need to have an efficient fundraising structure. Now, a fundraising structure is vastly different from that of like an investor search structure, for example, right? Fundraising, there you can, you know, either, you know, specifically have a fundraising strategy for, you know, smaller donations or for larger donations, depending on whom you target, and also combine that, but it would require a certain like fundraising strategy. Now, when we look, however, at, you know, repayable capital, that would mean that you would get an investor on board, or multiple investors on board. And there's different ways of doing that, and there's different financing structures to use, such as debt, mezzanine, and equity. And I will share later on what they exactly mean and how they differ. And for what type of social enterprise that might be, for example, a good idea and at what stage as well. So essentially, message here is non-profit, go for kind of like the fundraising part. If you have a hybrid or a for-profit business model, you can also look into the repayable capital, which essentially means that you would be looking for impact investors to invest into your company. So very often we do get asked the question, now, like you talk a lot about impact investors, and obviously at FASE we do talk a lot about impact investors, but who is actually an impact investor and how do they really differ? And essentially, even among impact investors, we typically classify them in different categories because it's quite essential to understand who you have to approach depending on what type of business you have. So I still put here like the donors. The donors, we talked about them, not part of like impact investing. They are just donors. They give you money. They don't want it back. That's great as well, but that's not investing. On the right-hand side of this slide, you see something called finance only, and finance only means essentially that they are just financially driven investors. They do not really care about impact. They don't have any impact expectations, but they expect their money back and typically expect market rate returns or higher. Now, in the context of, let's say, impact startups or social enterprise, those finance only could typically be something that we would be calling venture capital investors that, you know, have very high return expectations. They want to have a clear path to exit. They want to sell their shares of the company later on. We sometimes do see an overlap to impact startups, especially when it comes to climate, for example. But typically, in particular for social enterprises, those finance-only investors are typically not the ones that you would be looking for because the worlds are just different, essentially. That leaves us with different types of impact investors that can become relevant when you have a social enterprise or an impact startup. And we essentially classify them in 3 different categories: impact only, impact first, or finance first. And essentially, when we look at impact only investors, what that means is that they do invest money. Let's say you need 100,000, you get an impact only investor that gives you 100,000 euros, for example. They do, after a period of maybe 5 years or 10 years or whenever that might be, they do expect their money back, but they don't really care whether you give them like still like an interest rate on top or not. As long as they get their money back, that's fine for them, essentially. However, what they do expect is that money is being used to create a lot of positive impact. Now, those would obviously be the investors that, as a social enterprise, you would be very happy about. They give you the money, they put it to work, you create a social enterprise that works on a social cause, and once you have kind of like some sort of like little profits, you can pay the investor back in a self-sustaining business model. The impact first investors, they are relatively similar. They also expect their money back, like all investors do, and they expect some sort of like moderate returns. What does moderate returns mean? Now, it's not so easy to describe what exactly it means, but typically, for example, when we look at crowdfunding platforms, for example, there's a lot of crowdfunding platforms out there. In Germany, for example, most prominently, we have like GLS Crowd, which is like part of the GLS Bank, like a socially and environmentally friendly bank that has like a large crowdfunding community. When we see investments into social enterprises on their website, on their platform, moderate returns might be something between 6 and 8% of interest per year over the duration of maybe 5 years. That would be something like moderate returns. Anything kind of like below 10% would be considered somewhat like moderate returns. So they still obviously want to have their money. They want to have some moderate returns, but the main focus for them is still impact. And so they want to invest the money so that it's being put to good use impact-wise. So that would be the impact first investors. Now, finance first investors, we would still, for example, classify them now under impact investing. They do expect their money back. They also expect impact. However, they expect also something like almost market rate returns. Now, market rate returns is always a little bit, again, what I mentioned, difficult to to define what that essentially means. What we see from the venture capital world, so essentially like early stage financing in startups that where it's not clear yet whether they make it or not. So it's like a very high risk opportunity. That this high risk essentially correlates with a high potential for reward. So when we look at, for example, venture capital investors and also the like that would be similar to finance first investors, they could, for example, expect that they triple their money, or maybe even like 5 times or 10 times their money, initially invested money. So it's like very high returns, but it is because there's a very high risk involved. So like things will be financed that, for example, a bank or a crowdfunding platform or the like might not finance because the risk would be too high. So essentially what it means is there is not that one impact investor. Impact investors are different, and essentially they differ in particular with regard to the financial return that they expect and the impact that they would want to create with their investment. So I mentioned earlier that there's different financing instruments still for impact investment, for impact startups and social enterprises. And I want to share real brief kind of like the 3 main instruments, because this is also very closely correlated with what type of investor or what type of like funding instrument you can actually get for your company. So the first one, what it's typically kind of like associated when you hear the term investment, very often like people associate investment with, I give away a part of my company, let's say 20% or 30% of my company will be owned by the investor, and therefore I get money. So that's something that is typically in common language considered an investment. And that is partially correct. That is an investment. It's a specific type of investment, which is called equity investment. So essentially, it means that what I described, the investor buys part of your company, gives you money for that, and you can use that money to build your company, essentially. What it means, however, though, is that essentially, it only makes sense for the investor to invest in this type of instrument if they have a clear path to what we call exit. So let's say if you are a climate tech startup, impact focused, but in the topic of climate, let's say renewable energies, for example, or green hydrogen, or wind power, for example. If like an investor invests in that, maybe it's like still risky. You still need to develop the technology, for example, because I don't know, like your solar panel is much better than that of like others like on the market, for example, but you need a few million euros to finance that development, for example. Now there will be investors who are willing to invest that, but because they, for example, expect that now you are still we consider small startup, you need maybe 1 million or 5 million euros, but in 5 years' time, maybe that investor thinks they can, sell the shares of the company for 100 million euros or 50 million euros, and therefore make a big profit out of that. So that's why, for example, climate tech, these types of investments are very common, because especially when it comes to R&D heavy topics, especially when it comes to, certain like untapped market potentials where other companies might want to buy over your startup company, then it will be a very interesting mechanism to finance it, for example. To be fair, though, and that is something that we always have to like look at when we speak with social enterprises, this type of financing instrument might not always be the best case for social enterprises, because essentially if you run a social enterprise, you don't necessarily want to sell your company, but you actually want to build a company that serves a social purpose, and therefore actually want to like run that company and not necessarily build it to sell to get rich, for example. So there's other types of like financing instruments that are interesting when it comes to, for example, a social enterprise. One of them would be, and that is equally actually relevant for any company, would be debt. Now, debt typically is what you sorry, now I'm hearing kind of like an echo. I don't know who just let me mute everyone again. So I think now the echo is gone. So debt essentially is what you typically know from when you go to a bank. So like a bank gives you kind of like a loan, whether that is for, let's say you want to purchase a cargo bike, or whether you want to purchase a house, or whatever that might be, right? So typically that would be associated with debt. And the same also goes for companies and for social enterprises, impact startups, the like. The question is always, as a social enterprise, especially when you're early stage, are you what we consider bankable yet, in the sense of that they are willing to give you a bank? Because typically what we see is that banks very often require some sort of like personal guarantee or some security in order to give you a bank. So that means if, let's say, you're a social enterprise and you need 100,000 euros and you go, for example, to, like the bank here in Berlin, where I am, for example, then they would say like, yeah, okay, we're willing to give you 100,000 euros for your social enterprise, but you need to personally guarantee that if the company cannot pay back the loan, that you as a person will have to pay back the loan. And if it takes you 10 more years because you need to like get another job and then pay it back, then so be it. So we are very, as advisors, for example, always very careful with that, because essentially you don't want to necessarily, you already have like a risk of being an entrepreneur. You have a risk of like running your social enterprise or an impact startup. So essentially taking on more risk, in particular as a private individual, and it can be quite a burden. So it's not always possible to get it on the first place. And sometimes then if you can get it, the challenge is that it might have to be secured. Now, there are exceptions to that, and there are new loan programs coming out from certain types of banks that, for example, take over the guarantee when it comes to, for example, financing social causes, but it seems to be only in the infant stages. So it's not yet such a big kind of like opportunity yet. So that leaves us kind of like with the last form, and that is typically the form that we see most often actually for social enterprises. And that form is something that we call mezzanine capital. Mezzanine capital essentially combines the two worlds of like an equity and debt. So essentially what that means is, and I mentioned, for example, the topic of crowdfunding platforms. Crowdfunding platforms very often give out mezzanine capital, and mezzanine capital essentially means it's in that regard a subordinated loan. That means you get a loan, but the problem with the loan is always like if you cannot pay back. And the subordination of this loan essentially means that if you get it, that you don't risk, for example, bankruptcy of the company if you cannot pay it back, and you also typically don't have a personal guarantee with it. So very often what we do see, therefore, is that especially for impact startups and for social enterprises, that the subordinated loans are a very good option of getting capital, because like you don't need to have a clear pathway to exit because you pay back the loan over time. And at the same time, you don't risk, for example, over indebtedness because it's subordinated and therefore it's not a bank loan. We have multiple examples of like how we work with that in the past, and FASE, where I work, we co-initiated an investment fund also about 2 years ago. It's called European Social Innovation Impact Fund, that invests only in subordinated loans. So up to 400,000 euros, for example, that will have to be paid back over the duration of like 5 to 6 years. With like kind of like very moderate like interest rates in order to like enable the impact to stay in the company, in the social enterprise, and not like, have the money taken out by, overly by external investors. So those are 3 different instruments that we typically see with mezzanine. One of the very prominent ones in particular for social enterprises, if you decide to get, for example, external financing. As mentioned before, if you have a social enterprise, if you have an impact startup, there's different financing options. One would be that of internal financing, meaning through your own revenues, through public programs that, for example, pay for like the services that you provide to the beneficiaries, for example. And there's external options, and external ones would be those of like grants, of donations, if you're a nonprofit, for example, or grants and external investment, such as equity, mezzanine debt, if you are in particular a for-profit or a hybrid company. So I have one last slide, and then I would be also more than happy to also open the round for questions, because very often we still do get asked the question, who are actually those kind of like, impact investors? Because I mentioned a lot, there are impact investors, they have different return expectations. Some look more at finance, some look more at impact, but who are they actually, and how can I reach them essentially? So there's different types. So typically what I put on the slide here, there's something called business angels. That's typically private individuals that invest their own money into a social enterprise or an impact startup. There's crowdfunding platforms that do the like, similar to social business angels that have like more of a social focus. Foundations that also invest. So like very interesting also to point that out. Foundations very often have kind of like two purposes. One would that be of like being for example, a grant-making foundation, so that they essentially give money out so that a social enterprise can finance their projects. But more and more, what we also do see is that the foundations that, for example, have a large enough capital stock, for example, that they also invest this capital into impact startups and social enterprises to, create a return kind of like on that, and don't only give out grants. So that's something very interesting to look at as well. Family offices would be typically like the ones of wealthy individuals, families that have their own investment arms. And then on the right-hand side, we have kind of like the social venture fund and the venture capitalist fund that are very professionalized investors that also have very high return expectations, and the banks that I mentioned before. Now, the difference, and what I mentioned here also in the slide, is like some of them invest their own money and in particular have more like a long-term focus and more of an impact focus, and other, in particular when it comes to institutionalized investors, invest other people's money, which is why they sometimes are more rigid, more stringent when it comes to like evaluating investments in the first place. With that, I would also kind of like come to the end of like the topic that I have prepared for you. If there are any questions, now would be the time to discuss that. So I would suggest either you can type it in the chat, or feel free to unmute yourself and post the question directly, and I'd be happy to answer them as good as I can. So yeah, thanks a lot, first of all, for joining the webinar today. And yeah, if there's any questions now, feel free to ask. So far, I haven't seen anything in the chat. And I also haven't seen anyone unmuting themselves yet, which is okay. I mean, if there's no questions, then there's no questions. But I'll give you a few more seconds to think if there's anything that you would like to discuss. And if not, you also see there my email address. So if there's anything else that you would like to follow up on, which is also obviously totally fine.
Okay, I have a question.
Right, one question.
Yeah, hello.
Hi there.
So, hello, my name is Bogna. Thanks for your impulses. It was very fast, so I needed some time to, to let it soak it in. The questions is not easy to verbalize, but what kind of method can you suggest to test out your business model through these different financing models? How can you find the business model that is the best for you?
Yeah, it's a very, very good question. And I think in the end, the business model is, so let's put it this way. I think, first of all, I think it would be helpful to understand very well what is kind of like the target group, like whom do you want to solve the issue for, essentially, and do they have a willingness to pay? If they do have a willingness to pay, for example, or the ability to pay, then it could be very interesting to essentially also look into, for example, a for-profit business model. Or if, for example, you, let's say, think that there's other kind of like entities that can pay for it. Let's say, for example, if you think of the field of like digital health, for example, maybe someone might not pay for a digital health application, but the health insurance would. So that would also be, for example, a business model where it could go into the for-profit world, and therefore kind of like external investment from impact investors could be, for example, interesting in that case. Now, if you, for example, on the other hand, let's say you work, for example, as a social enterprise in the field with, like, let's say, homeless people, for example. So like typically homeless people might not have the ability to pay for a certain service, for example. So it might, in that case, for example, better to be structured as a non-profit, because it might be easier to get, for example, donations for this particular cause that you're working with, rather than build a business model out of that can create some sort of like profitable revenues. So I think I would start with kind of like the target group and trying to understand if there's an ability to pay and who could pay for it. And if you identify that there is something, you could look into going to, for example, a for-profit or a hybrid model. But if you realize that it's really purely a social cause, that it should be, for example, rather be solved donation-based, then maybe a non-profit and kind of like the fundraising path might be the more interesting one to go for.
Wow, thank you. And that was very clear. And if there are two target groups, like two stakeholder groups, one is not willing to pay or not able to pay, the other is, but is more like a B2G model, like governance model and so on. So what would be the approach to this? And the other group is like you mentioned, for instance, a homeless group, or right.
So I think one possibility could be to also structure it in a hybrid way. So what we do see sometimes is that, for example, an organization might have a non-profit entity and a for-profit entity. So that the non-profit entity, for example, takes care of those beneficiaries that, cannot pay, for example, and therefore you get donations to, for example, fund this aspect of like of your social enterprise. And then you have, for example, a for-profit entity where you can channel, for example, income where other entities can, for example, pay for that. And that could mean essentially that on the one hand, you can go, that's essentially fundraising for donations via the non-profit entity, but you could also, for example, look into, for example, different types of financing with, for example, impact investors on the for-profit entity. So kind of like combining those two areas is possible, and we've seen that in the past. It's not the easiest way, to be fair, but it's definitely possible.
So it's not about splitting, like having both stakeholders in a non-profit and a for-profit group model. It's more about having one stakeholder group in one and the other stakeholder group in the other model, or is it also working like both in both models?
I think I think we would have to look at this case in probably more specifics. I think it's maybe a bit challenging to like comment on it relatively vaguely, because I think we would have to like do a little bit more of a deep dive, but feel free to reach out to me via email and I'd be happy to have a chat.
Thank you very much. Yeah.
No worries. Thank you. All right, let me look at the chat real quick, because I do see that there are some questions in the chat.
I can ask a question as well if it's just people.
Yeah, I think we have one question in the chat real quick, and then I answer this. And then, so how significant is the difference for a company to be bootstrapped versus incorporated when it comes to sourcing funds? If I rephrase, yes, if I rephrase, is registering a company essentially to fundraise? Yes, it is. Typically, you will only be able to fundraise if you're registered. It doesn't matter which entity that might be. That can be a GmbH, like a for-profit, or it can be a non-profit. But essentially, without being registered, it might not be possible to fundraise yet. In very, very limited cases, that might be. And just real quick with regard to bootstrapping. So bootstrapping essentially means that you might not rely on external funds, but you can still be incorporated and then bootstrap out of the incorporation. So I hope that answers this question. And then I think, Nikki, you were the one who had a question, right?
Yeah, thanks, Christoph, for today. Sorry if it's a little loud. I'm picking up my kids right now. But so there's a variety of reasons why traditional VC funding and quick exit obviously doesn't work for social entrepreneurs. And since you have an overview of some of the different options out there, from your perspective now, a couple years in, what are you seeing as the greatest success rate between like a successful marriage of for-profit while also allowing entrepreneurs the freedom to pivot, the freedom to grow slowly and stay true to purpose, something that works well for both founders as well as for the people looking to invest?
Yeah. So I think when we come from, like, let's say, especially the social venture capital fund world, what we typically do see when it comes to in particular impact is that they look in particular, is impact really part of the business model? As in, is, let's say, how can we ensure that there's no mission drift involved when investing? So essentially, it means that when the company grows and becomes financially more attractive and more successful, does the impact automatically grow with it? And if this correlation is there, then it becomes a very interesting investment target for social venture capital funds, because on the one hand, they have the opportunity to get their financial return on their investment, but on the other hand, also to essentially create more impact. Just to give you kind of like one example that for example we have been working with in the past. So we've been working with a company called Blaue Helden out of Germany, which is essentially a replacement of like toxic cleaning products to like, instead of like buying like a bottle of like cleaning products in the supermarket, you buy essentially a little pack of powder, you mix it with water, you have therefore less plastic waste, you have like, biodegradable ingredients. So the bigger the company gets, the more environmentally positive impact will be created, because there will be lack of, less plastic involved, less toxic materials being produced. So essentially for impact investors, a very interesting case, because the bigger the company gets, the more interesting, because more impact will be created, while at the same time, for example, having a clear possibility for exit, because maybe one day one of the big, FMCG companies might buy over this company and think this is a worthwhile investment as well. I hope that answers the question, Nikki.
Yes, it does. Thank you so much. I appreciate it.
Great.
And the specific example is helpful too.
Thanks. Great. Then we have one more question. Where can we download the presentation? The presentation can be downloaded. Let me quickly go back to one of the first slides. Martin, here you can see the link online. It's Kompetenzzentrum-soziale-innovationen.com. And there you can download. I think you cannot download the presentation, but you can rewatch the presentation. I think that's how it's supposed to be structured. All right. Any further questions? If this is not the case, then I would say big thanks to all of you, and thanks for the great questions now in the end. I hope it was useful. Feel free to reach out if there's any further questions, and yeah, have a good day.